Time once again to check on the latest earnings trends with Zacks Director of Equity Research, Dirk Van Dyke. Dirk, with all eyes on the financial bailout discussions that are going on at the time of this recording, maybe third quarter earnings season has taken a bit of a backseat. However, there are still some trends out there that you outlined that I think are worth talking about. One is that you're really not sure at this point just how much of the financial sector is going to be included in the third quarter results. And is that because of the situation that we're in?
Yeah, I mean, look back a year ago, major players in the financial system, big part of their earnings or losses is, third quarter last year earnings, fourth quarter losses, Fannie Mae, Freddie Mac, American International Group, Lehman Brothers, Merrill Lynch. That probably won't be combined with Bank of America yet. Even Bear Stearns was still around. So those are big players that may or may not even be in the index by the time that you get the results in, and almost certainly won't be in the fourth quarter. Which really throws a monkey wrench into doing these year-over-year comparisons.
Yeah, and also of note, in fact, more important than the reported results you bring out are the expectations for about 488 firms that have not yet reported. We don't know what direction those reports are going to take. We do know at this point that estimates for the banking sector have been cut, continue to be cut.
Yeah, I mean, there have not been an avalanche of estimate revisions yet. I suspect most of the analysts were sort of glued to their screens trying to make heads or tails out of everything that's been going on. But for the third quarter, a week ago, we were looking at a 50% decline, almost a 50% decline in year-over-year total net income. Now it's 60%. And that 60% is, I think wildly optimistic. I mean, it's just that the analysts haven't gotten to cut their estimates yet. I mean, we're in a normally very slow time for estimate revisions under any circumstances. There's a very distinct seasonal pattern. You get a lot of revisions during earnings season, and then it trails off. And so not a lot of changes yet, but those changes did result in a 10% decline in the expected total net income for the financial sector, which caused the overall S&P decline in net income to go from about 3% down to about 5%.
Is this the first time in your recollection that maybe earnings have not taken center stage in a quarter? At least in a long time? At
least in a long time. It's certainly an unusual occurrence. And, earnings will eventually come back to the fore. I mean, those are the economic fundamentals that people should be investing on. But there's a great deal of uncertainty about the earnings, given, which way this whole bailout thing goes. If you're going to be showering $700 billion on a given sector, it's going to affect somebody's earnings.
Right. So for those people who still want to keep an eye on the trends here as far as earnings are concerned, at least for 3Q, and we don't want to sound redundant or like a broken record, but you're still calling for energy to have the best results by a wide margin. Now, I would have thought that they would have had their day in the sun, but is this the lag effect that we're seeing, even though with the downturn in oil?
Well, I mean, we got to remember oil is still very much higher than it was a year ago. It's not as high as it was, 2 months ago. But, a year ago you were looking at, $65 to $70 oil. Now you're looking at, for the average of the quarter about, $105 oil. That's a pretty good size move. I mean, it's just not the $145 oil that it went to. So there's good reason for energy to far and away blow by everybody else.
All right, you're looking for energy to gain 33.3%, technology coming in second with a gain of 11.8%, healthcare and industrials close on the heels of that at 11%. No surprise, the financials going to be posting the worst performance according to your report.
Yeah, those are, just to be clear, those are the median year-over-year EPS growth numbers. On a total net income basis, the disparities are much wider than on the median level.
Okay. With all of this talk recently, like in the past couple days, about the retail sector maybe posting some poor holiday sales, poorer than they've posted as far as, poorer gains that they've posted than they've posted in a long time. Where do you see the retail sector falling in the overall scheme of third quarter earnings?
The Grinch is going to dominate this Christmas, not Santa Claus. Let's just be really clear about that. And, back to school was a bit of a bust. But the retailers had anticipated that and had pretty lean inventories, so they may not be a total disaster, but it's not going to be happy times for the retail sector this Christmas. It seems almost inconceivable that it would be.
And quickly, what is that ever popular revisions ratio telling you at this point?
It's telling me that things don't look that good for both this year and next year. More than twice as many estimates have been cut as increased. There's no sector for either year that's truly in positive territory, which we define as better than a 5-to-4 ratio, or 1.25. The best we have is actually, surprisingly, the consumer discretionary sector, which for this year is at 1.07, so in neutral territory, but it's pretty much ugly across the board. In financial services, way down again at the bottom. As
analysts continue to cut estimates.
Yeah, but energy is not looking that good on revisions. Tech isn't looking that good on revisions. Utilities, you name it. It's kind of across the board. But fortunately, it's not based on a huge sample of estimate changes.
Okay. So if there's a positive to it, that would be the positive.
Yeah, that you're based off of a pretty small sample size, yes.
All right. We will keep checking in with you weekly on the latest earnings trends. And Earnings Trends provides investors with an in-depth analysis of the markets along with the profit performance of S&P 500 companies. Each week the report identifies which S&P 500 sectors are showing strength, which are showing weakness, and also the report highlights the most attractive sectors based on valuation and projected earnings growth. You can see Dirk's entire earnings commentary for this most current week, including his median growth and revisions tables. I strongly suggest you link to it right off of our homepage at Zacks.com. It will keep you up to date on the latest earnings trends. With Dirk Van Dyke, I'm Terry Ruffalo.